Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing you want to do is pull up any equities underlying in your portfolio. We can just have a look at UAL here, and we've got a position currently on UAL, but it doesn't matter. We just want to have any underlying open, and we want to see a list of expirations for that underlying. And the purpose of this step here is to see which expiration date we're going to choose and how far out in time it is. So the expiration date that we want to choose in this case should be between 30 and 60 days out in time, and it should be a monthly expiration, not a weekly or a quarterly expiration. The only expiration date that fits that criteria is December 20th, and it is 39 days out in time. So that's the one we're going to go with. December 20th, 39 days out in time. So now we can take that information, come over to our watch list, and simply filter out everything that has earnings over the next 39 days. And we can also filter out anything with a low liquidity rating level. Now you'll be left with something that looks like this. Obviously, it won't be exactly like this. This is just a pre-made standard watch list in the tastytrade platform. You can use any watch list you want. It doesn't matter. We are product indifferent. You can make your own watch list. The point is you'll have a list of underlyings to trade. I personally like to order everything from high to low IVR. We want to sell when IV is high and play the contraction back down to the mean. Volatility is mean reverting. Remember that. So now we simply just go down the list, and we want to see what would fit well inside of our portfolio. If we've got a lot of airline companies, for example, we've got UAL open right now, we're not really going to be looking for a position on BA, for example. Um, if you've got a lot of tech sector companies, maybe look at food or banking or something, or agriculture or precious metals, or just use common sense and it'll be fine. So at the top here we've got Tesla. Obviously Tesla's been on an absolute tear with post election. We've got NXE here. Coin. We've had a look at Coin. Obviously Coin is going to be doing well because Bitcoin is doing well post election. Nikola, Boyle, Patterson, SMCI, KRE, all of these have a pretty nice and high IV rank. We want to be looking for things with an IV rank of over 50. Um, Sometimes over 30 can be okay, but generally speaking, over 50. Let's have a look at XLF. It is one of the spiders. It is an ETF, and it has got a nice IV rank of 51. So if anyone that doesn't know, ETFs will help you eliminate company risk. You will make a slightly lower return over the year trading ETFs, but your P&L will be smoother. So let's have a look at XLF, and we already know what expiration date that we're going to be looking at. And this is now the options chain. So at this point, we simply just want to sell one call and one put. That's it. Really simple. And we want to sell them anywhere between 16 and 20 deltas, or 15 and 20 deltas, around there. So we've got a 16 delta on the call side. We can sell that. And then on the put side, we've got a 15 delta. We can sell that. So if we just if you have a look at our break even here, these are break even. This is our break even level here. This green bar and this orange bar shows you the expected move. So as you can see here, it is not expected for the price of XLF to move outside of this range that we've created for ourselves between $47 and $53. And that is reflected in our probability of profit, which is 73%. So that's a very high probability trade. And if we wanted to exit this position at 50% of max profit instead of holding to expiration, then we've got an 83% chance of being able to exit at some point on this trade, or 85% chance of being able to do that over the next 39 days at some point. And in terms of the numbers, how much money we'd make, we would collect $47 upfront in premium, and our broker is going to require just over $700 in buying power. So this is a low return on capital trade. However, that is also because IV is quite low on this. So IV rank is high, but absolute IV is low at 19%. So there's two different metrics that you want to keep in mind. But that's not to say that this would be a bad trade. For example, if we were to buy another contract a couple dollars away from our short strikes, we collect less premium up front, but our buying power requirement has reduced, and this does lead to a slightly higher return on capital trade. We can just go out a little bit further and keep playing with the numbers until we find something that we like. The return on capital here still isn't the best compared to other underlyings. However, it is important to have a mix of different a mix of varying IV levels in your portfolio, because if you have your portfolio made up of Tesla and Tesla equivalents and beyond from there, then your P&L is going to be looking very, very rough, as opposed to if every position in your portfolio was always an ETF. you know that's going to be somewhere on the other end of the scale. Your P&L will probably be very predictable, but your returns won't be anywhere near as good as what they would be in the Tesla portfolio, for example. So you want to have a mix, and you want to be somewhere in the middle, because we just don't know what's going to happen in the market. We've just got to play the probabilities, and that's the name of this game. So that's how you can find and manipulate positions. If you're unsure of how much buying power you should be allocating to your positions, then we have created a spreadsheet here that does it for you, that will tell you how much to allocate. To get a copy of this, just click the link in the description, click on free position sizing template, and it will take you to the spreadsheet. You can make a copy of this, keep it, it's free. The way it works is you enter in the size of your portfolio up top, and then you enter in what the current VIX level is below that, and then everything will then be automatically calculated for you, and you simply just need to use this information to form the backbone of your portfolio. And if you want to learn in more detail, again, link in description, click on EDS Premium this time and get yourself signed up. Once you are inside, you will have access to our portfolios that you can, where you'll be able to see the positions that we're opening, closing, how we're managing risk, how we're making adjustments. You can use that as insight into or inspiration, what you should be doing in your own portfolio, or if you simply just want to copy us, that is completely fine as well. There's a full course, so no prior knowledge is required. We will teach you everything you need to know. It's a private community, so you could speak with myself directly and with other like-minded individuals. There's also a 100% money-back guarantee. So once you have studied the full course and have been following our trades and positions for 6 months, if at that point you don't know what you're doing or you haven't been profitable for whatever reason, then we will work with you for free until you are, or you can simply request a full refund. So it is completely risk-free on your part, and right now it's only £1 a month to join. The price will be increasing, however, once you're in, you're in. So you are definitely rewarded for getting in early and locking in your low price. The price will never be cheaper than this, ever. So with that being said, I will see you guys on the inside.